Hello everyone and welcome. So April 20th, 2020 is a historic day for the oil market and oil market investors as the West Texas crude oil price fell to negative for the first time in history, and it bottomed out at negative $37. So what does this mean? Does this mean that they will be paying you to fill up at the pumps? And what does this also mean for investors that want to invest in oil? And this is what we are going to find out in this video. Now, why did the oil price tank? So there was a price war between Russia and Saudi Arabia, which is the head nation of the OPEC oil producing nations. Now, OPEC is basically a coalition that fixes oil prices for them to make a profit. And Russia is not a part of the OPEC nations, even though it is also a big producer of oil. Now, Russia did not want to go along with the plan from Saudi Arabia to decrease production. So a large surplus of oil is being produced. This, in combination with the historic fall in demand due to the disease that has been going around, has created the historic low prices. Now, if the oil price is negative, does this mean petrol at the pumps will be cheaper? The simple answer is no. Now, crude oil is used for making many products, such as plastic, rubber, oil, etc. And petroleum is simply one of the products that it makes. There is a cost to refining the product into petroleum, so the cost of petrol will never be zero. Now, this is similar to the case where if flour costs $0, a cake that's baked using flour will still cost a significant amount due to the labor and the time taken to make the cake. There's also the fact that taxes on fuel have increased significantly over the last 10 years. And lastly, the New Zealand petrol is measured against the Brent crude price, which has not fallen to the negative dollar value like the West Texas crude. What does this mean for investors actually wanting to invest in oil? So many retail investors have a rush into buying the oil ETFs, such as the United States Oil Fund on many popular trading platforms. And the USO has become the most traded stocks over the past couple of days, according to the market tracking tool at RobinTrack. As you can see, there's a giant spike up in the number of users holding the particular stock, which is the green line. Many retail investors do not actually know what they're actually investing in when they buy the USO ETF. Oil investors and ETFs, such as the United States Oil Fund, the USO, does not actually invest in actual barrels of oil. Instead, they trade oil future contracts. Now, what exactly is a future contract? A future contract is a contract to buy something at a certain date at a certain price. For example, I will pay $20 per barrel for oil on the 20th of May. Institutional investors buy up these contracts for oil, hoping to sell it off for profit later on. But because the demand is so low and they don't actually want to physically store any oil, they panic and sell off these contracts at a loss before it expires. And because of the huge surplus in production and fall in demand, the May contracts fell into the negative territory, and funds like the USO starts dumping these May contracts to buy up contracts for future months, thus creating even more selling pressure. So currently there is an unusual situation where the future contract is selling at a cost higher than the cost of oil at the moment. Now, this is the same as you paying $5 for a bottle of milk because the future contract says that someday milk is going to be worth $5 when the real cost today is $3. So the US oil fund does not actually invest in actual oil companies. Instead, it tracks the West Texas crude oil price. Now, this would work fine under normal circumstances, but currently, in the current condition, it does not track the prices effectively. For example, on Wednesday, the fund dropped 11%, even as the oil's June's future jumped 20%. And on Thursday, the June oil jumped 30% and USO only gained 12% ground. Needless to say, this creates a big problem for any potential investors in oil. So basically, the best thing at the moment is to stay away from oil price tracking funds like the USO. So what should you invest in if you do want to invest in oil? Now, one thing you could do is to invest in actual energy companies that produces and delivers oils, such as the ExxonMobil, which has the symbol XOM, and also Royal Dutch Shell, which is denoted by symbol RDSA. Alternatively, you can also invest in index funds that tracks those companies. So such a fund includes the Energy Sector Fund, the XLE, which tracks the energy sector in the US S&P 500 companies. This video is not meant to tell you whether or not you should actually invest in these stocks, but if you are interested in investing in oil, these are some of the possible options for you. Now, if you do want to purchase these stocks, you would need a broker, and one of the options on offer is Stake, and you can use my link down below to sign up to Stake and enjoy commission-free trading. I hope this video has helped you guys out if you are interested in investing in oil, and I will see you in the next video.